Hello everyone, welcome to the 95th episode of me learning how to trade in Forex. So in the last episode we went through the dollar smile theory, which is basically this smile here. So USD strengthens due to risk aversion, USD weakens to new low due to weak economy, and then USD strengthens again due to economic growth. So that's the three scenarios of the dollar smile theory. And then we can see that let's take a look at the dollar smile theory in reality. This is what would happen in reality maybe. So global recession, slowing the US growth, rest of the world growth and US recession. Rest of the world growth outpaces the US, slowing rest of the world growth, and the US growth outperforms the rest of the world. Strong dollars pros and cons. So US consumers is great, traveling to other countries and buying imported goods at home is cheaper. For non-US consumers, it's the opposite, so it's more expensive to visit the US, and then you have to pay more for imported US goods and commodities, such as oil. And then also, multi-international corporations generate a sizable percentage of their revenue outside of the US, meaning they'll experience a decline in profits when their revenue is exchanged from the local currency to the US dollars. So, now we're on how gold affects AUD/USD and USD CHF. Below, so how gold affects AUD/USD and USD/CHF. Date is the 4th. Right, how gold affects AUD/USD and USD CHF. Before we detail the relationship between the COM-DOLs and gold, let's first note that US dollar and gold doesn't quite mesh very well. Usually when the dollar moves up, the gold falls, and vice versa. Usually when dollar rises, gold falls. So when gold rises, dollar falls. The traditional logic here is that during times of economic unrest, investors tend to dump the greenback in favor of gold. Unlike the other assets, gold maintains its intrinsic value, or rather its natural shine. So, logic is that during times of economic unrest, investors tend to dump dollars for gold. Gold and AUD/USD. Nowadays, the inverse relationship between the greenback and gold still remains, although the dynamic behind it have somewhat changed. Because of the dollar's safe haven appeal, whenever there is an economic trouble in the US or across the globe, investors more often than not run back to the greenback. The reverse happens when there are signs of growth. Take a look at this awesome chart. Gold versus AUD/USD 2000 to 2011. So it's kind of like a mirrored relationship. When one goes up, the other goes up. One goes down, the other goes down. Up, up, down, down. Currently, Australia is the third biggest gold digger. We mean gold producer in the world, sailing out about 5 billion worth of yellow treasure every year. Gold has a positive correlation with AUD/USD. Wait, however, this isn't guaranteed, as due to the dollar's safe haven appeal. Take a look at this awesome chart. Gold has a positive correlation with AUD USD. So using US dollars to buy Australian dollars. When gold goes up, AUD USD goes up. When gold goes down, AUD USD tends to go down. Historically, AUD USD has had a whopping 80% correlation to the price of gold. Not convinced? Here's another one. Gold and USD CHF. Across the 7 seas, Switzerland's currency, the Swiss franc, also has a strong link with gold. Using the dollar as a base currency, the USD CHF usually climbs when the price of gold slides. So as gold increases, USD CHF decreases. Conversely, the pair dips when the price of gold goes up. Unlike the Australian dollar, the reason why the Swiss franc moves along with gold is that more than 25% of Switzerland's money is backed by gold reserves. Gold has a negative correlation with USD CHF. When gold goes up, USD CHF goes down. When gold goes down, USD CHF goes up. Do that. Correlation of AUD. Reason being, Australia is the third biggest gold producer in the world. So, what's the other one? Gold has a negative correlation with USD CHF. Conversely, the pair dips on the price, so you're trying to sell CHF to buy USD. The reason why the Swiss franc moves along with gold is that more than 25% of Switzerland's money is backed by gold reserves. Gold has a negative correlation with USD CHF. When gold goes up, USD CHF goes down. When gold goes down, USD CHF. So if 25% of Switzerland's money is backed by gold reserves, that means, so let's get my head around, as the gold price goes down, 25% of Switzerland's money also goes down. So if CHF decreases, then to get whatever the same amount of USD it used to be before it decreased, the USD also decreases, right? No, as CHF decreases, the USD should stay the same, because you're just paying less CHF to get the same amount of USD. So USD should stay the same. So if CHF decreases, so you're paying less, oh no, you need to pay more, no, you need to pay less CHF to get 1 USD. No, wait, that means USD is weakening against CHF, that isn't right, so you need to pay more. So CHF should increase here, because you need to pay more CHF to get the USD. Yeah, so as the gold price goes down, Switzerland's money also goes down. The 25% of Switzerland's money also goes down. So that would mean you need to pay more CHF in order to get the same amount of USD. I don't even think what I said makes any sense. So if it's 25% of Switzerland's money is backed by gold reserves, wait. If gold increases, if the price of gold increases, then that would mean, what does it mean backed by gold reserves? So they're using gold reserves as their currency. So if the price of gold increases, that would mean they can use less. If price of gold increases, they could use less of CHF to exchange for the same amount of USD. So as gold increases, USD CHF goes down. Yeah, I guess that. Okay. Yeah, I think that makes sense to me. Let me just write this down. USD CHF. Reason being 25% of being more than 25% of Switzerland's money is backed by gold reserves. When gold goes up, USD CHF goes down. When gold goes down, USD CHF goes up. Isn't that awesome? Keep in mind that this is correlation and not set in stone and may change in the future. The relationship between gold and major currencies is just one of the many that we will tackle. Keep reading. So, oh, actually, I do need that thing here, so I can do this like that. How oil moves with USD CAD. USD CAD. Let's talk about the other kind of gold, the black one. As you may know, crude oil is often referred to as the black gold, or as we here at babypips.com like to call it, black crack. One can live without gold, but if you're a crack addict, you can't live without crack. Okay? Oil is the drug that runs through the veins of the global economy, and it is a major source of energy. Canada, one of the top oil producers in the world, exports over 3 million barrels of oil and petroleum products per day to the United States. This makes it the largest supplier of oil to the US. This means that Canada is the United States' main black crack dealer. So Canada 37.1, Saudi Arabia 15.8, Mexico, Venezuela, Kuwait, Colombia, Iraq, other. Because of the volume involved, it creates a huge amount of demand for Canadian dollars. Also take note that Canada's economy is dependent on exports, with about 85% of its exports going to its bigger brother down south, the US. Because of this, USD-CAD can be greatly affected by how US consumers react to changes in oil prices. So, Canada is one of the top oil producers in the world. Canada is the largest supplier of oil to the US. because of the huge volume involved, it creates a huge demand for Canadian dollars. Also take note that Canada's economies depend on exports, with about 85% of its exports going to its big brother down south, the US. Canada's economy is dependent on exports. Canada's economy is based on exports. Because of this, USD CAD can be greatly affected by how US consumers react to changes in oil prices. Can be greatly affected by how US consumers react to changes in oil prices. So however much you're selling USD CAD to buy 1 USD. If US demand rises, manufacturers will need to order more oil to keep up with demand. This can lead to a rise in oil prices, which might lead to a fall in USD CAD. Because if the price of oil increases, a fall to USD CAD means you can pay less CAD to get 1 USD, which means USD is weakening against the CAD, because increase in oil price means you want more of the CAD currency than USD. So CAD is strengthening against USD, which means USD/CAD is going to fall because you need less CAD to get 1 USD. If US demand rises, manufacturers will need to order more oil to keep up with the demand. This can lead to a rise in oil prices. This can lead to a rise in oil prices. Which might lead to a fall in USD CAD. If US demand falls, manufacturers will need to might order less oil since they don't need to make more goods. This can lead to a fall in oil prices, which might lead to a rise in USD CAD. So if US demand falls, manufacturers may decide to chill out since they don't need to make more goods. Demand for oil might fall, which could hurt demand for CAD. So if demand decreases, then its price is gonna decrease as well. Its strength is gonna decrease as well. Oil has a negative correlation with USD CAD of about 93% between 2000 through 2016. Oil has a negative correlation with USD CAD. So as oil prices go down, USD CAD goes up. As oil prices go up, USD CAD goes down. When oil goes up, USD CAD goes down. When oil goes down, USD CAD goes up. And to make the correlation clearer, we can invert USD CAD to show how both markets move pretty much at the same time. invert the USD CAD, so flip it around, i.e. crude oil will gain value with the Canadian dollar while US dollar falls and vice versa. Check out in the chart below. Crude oil futures versus USD CAD inverted 2000 to 2016. So pretty much the same. So the next time you gas up your car and see that the oil prices are rising, you can use this information to your advantage. It may be a clue for you to go short on USD CAD. Some Forex brokers allow you to trade gold, oil and other commodities. There you can readily pull up their charts using their platforms. You can also monitor the price of gold on Yahoo Finance. You can likewise check the prices of oil on Bloomberg as well. Cool. The US dollar and oil relationship is changing. Historically, the price of oil is inversely related to the price of US dollar. The explanation for this relationship is based on two well-known premises. A barrel of oil is priced in US dollars across the world. When the US dollar is strong, you need fewer US dollars to buy a barrel of oil. When the US dollar is weak, the price of oil is higher in dollar terms. The United States has historically been a net importer of oil. Rising oil prices cause the United States trade balance deficit to rise as more dollars are needed to be sent abroad. The former still holds true today, the latter not so much. Due primarily to the success of horizontal drilling and fracking technology, the US shale revolution has dramatically increased domestic petroleum production. In fact, the United States became a net exporter of refined petroleum products in 2011 and now has become the largest producer of crude oil, overtaking Saudi Arabia and Russia. Historically, the price of oil is inversely related to the price of dollar. This is due to a barrel of oil is priced in US dollars across the world. When the USD is strong, fewer dollars are needed to buy a barrel of oil. When the USD is weak, the price of oil is higher in dollar terms. The US has historically been a net importer of oil. The US has been net oil, therefore rising oil prices caused the US trade balance deficit to rise as more dollars are needed to be sent abroad. The former still holds true today, the latter not so much. However, the second point isn't that much true nowadays. Nowadays, the US has become a net exporter of refined petroleum products. So, Statista. Let me just give a copy in here. Picture format. According to the Energy Information and Administration, the United States is now about 90% self-sufficient in terms of total energy production. The technological breakthrough of fracking has disrupted the status quo in oil production, much like how Kylie Jenner's lip kits disrupted the status quo in the cosmetic industry. As US oil exports have increased, oil imports have decreased. This means that higher oil prices no longer contribute to a higher US trade deficit and actually helps to decrease it. As a result, we've seen the historically strong inverse relationship between oil prices and the US dollar is becoming more unstable. So as US oil exports have increased, oil imports has decreased, meaning higher oil prices no longer contribute to a higher US trade deficit and helps to decrease it. Therefore, the historically strong inverse relationship between oil prices and the US dollar is becoming more unstable. Spot crude oil price, the black line, trade weight US dollar index, the blue line. So it's still kinda inverse. Oh, except up to here where this bit's rising, this bit's kinda rising as well. Over the past 8 years, the rolling 6-month correlation coefficient was mostly negative, but that's starting to change. 6-month rolling correlation between oil and DXY price index. Considering the new dynamics of the global energy market, it wouldn't be surprising to see this historically negative correlation spend more time in positive territory. The relationship between the oil and the United States seems to be changing, reflecting the country's growing role in the global oil industry. Is the dollar becoming a petrocurrency? a term given to the currencies of countries like Canada, Russia and Norway that export so much oil that oil revenues make up a large part of their economy. The United States has become the new swing producer of oil, meaning that its production levels hold the most influence over global oil prices. Before the shale revolution, it was Saudi Arabia. The US may start to trade more like a petrocurrency in the years to come, as the US continues to grow the share of oil exports over imports. Revenue from oil will play a greater role in the US economy, and the US dollar may start behaving like a petrocurrency, meaning when oil prices goes up, so does the currency. As the US continues to grow the share of oil exports over imports, revenue from oil will play a greater role in the US economy. Which could mean as oil prices go up, USD goes up. USD also goes up. Understanding why the dollar has historically traded inversely to the price of oil and why the correlation has weakened recently can help traders make more informed trading decisions as the global economy continues to evolve. So, how bond yields affect currency movements? Affects currency movement. A bond is an IOU issued by an entity when it needs to borrow money. What's an IOU? A bond is a IOU issued by an entity when it needs to borrow money. Is an IOU issued by an entity when it needs to borrow money, right? These entities, such as governments, municipalities, or multi-international companies need a lot of funds in order to operate, so they often need to borrow from banks or individuals like you. When you own a government bond, in effect, the government has borrowed money from you. When you own a government bond, in effect, the government has borrowed money from you. You might be wondering, isn't that the same as owning stocks? One major difference is that bonds typically have defined term to maturity. Bonds typically have a defined term to maturity, wherein the owner gets paid back the money he loaned, known as a principal, at a predetermined set date. So the owner gets paid back the money he loans, known as the principal, at a predetermined set date. Would there be interest on this? Also, when an investor purchases a bond from a company, he gets paid a specific rate of return, also known as a bond yield, at certain time intervals. When an investor purchases a bond from a company, he gets paid at a specified rate of return, also known as the bond yield, at a certain time intervals. When investors purchase a bond from a company, they get paid at a specified interval, or a specified rate of return, known as the bond yield, at certain time intervals. They loaned, whoops, can't talk spell, so the owner, at certain intervals. These periodic interest payments are commonly known as coupon payments. The periodic interest payments are commonly known as coupon payments. Bond yield refers to the rate of return or interest paid to the bond holder, while the bond price is the amount of money the bond holder pays for the bond. So bond yield, the rate of return or interest paid to the bond holder, while the bond price is the, oh no, in a different line, bond price, the amount of money the bond holder pays for the bond. Now bond prices and bond yields are inversely correlated. Bond prices and bond yields are inversely correlated. So as one goes up, the other goes down. When bond prices rise, bond yields fall, and vice versa. When bond prices rise, bond yields fall. Here's a simple illustration to help you remember. Still confused about, how about this one? If interest rates rise, price fall, yields rise. If interest rates fall, price rise, yields fall. Wait a minute, what does this have to do with currency markets? If interest rates rise, prices fall, yields rise. If interest rates fall, prices rise, yields fall. Alright, okay, let's ignore that question for now. Always keep in mind that inter-market relationships govern currency price action. So inter-market relationships govern price action. Currency. Inter-market relationships. Bond yields actually serve as an excellent indicator of the strength of a nation's stock market, which increases demand for the nation's currency. Bond yields serve as an excellent indicator of the strength of a nation's stock market, which increases the demand for the nation's currency. Which increases demand for the nation's currency. For example, the US bond yields gauge the performance of the US stock market, thereby reflecting demand for the US dollar. So, i.e. US bonds gauge the performance of the US stock market, which reflects the demand for the USD. Let's take a look at one scenario. Demand for bonds usually increases when investors are concerned about safety of their stock investment. So demands for bonds usually increases when investors are concerned about the safety of their stock investment. This flight to safety drives bond prices higher, and by virtue of their inverse relationship, pushes bonds yields down. As more and more investors move away from stocks and other high-risk investments, increased demand for less risky instruments such as the US bonds and the safe haven US dollar pushes their price higher. Government bond yields act as an indicator of the overall direction of a country's interest rates and expectations. Therefore, increases the bond prices and then decreasing the bond yields. Government bond yields act as an indicator of the overall direction of the country's interest rates and expectations. For example, in the US you would focus on the 10-year Treasury note. A rising yield is a dollar bullish, a falling yield is dollar bearish. 10-year Treasury note. A rising yield is a dollar bullish, is dollar bullish. A falling yield is dollar bearish. A rising yield is dollar bullish, so if the yield is rising, then interest rate rises, prices fall. Oh no, if yields rise, the bond prices fall. So if the bond prices falls, that means if bond prices falls, how does that make dollar bullish? If the bond prices fall, if the bond prices falls, a falling yield, as the yield falls, the prices rise. So the bond prices rise. It's important to know the underlying dynamics of why bonds yield is rising or falling. It can be based on interest rate expectations, or it can be based on market uncertainties and a flight to safety with capital flowing from risky assets like stocks to less risky assets like bonds. So the falling yield, if yield is falling, prices rise. Wait, yeah, so if the bond prices goes higher, that means US bonds and safe haven US dollar pushes their price higher, so the US dollar should also go bearish as well, no? No, bullish, I mean. After understanding how rising bond yields usually cause a nation's currency to appreciate, you're probably itching to find out how this can be applied to Forex trading. Patience, young Padawan. Recall that one of our goals in Forex trading, aside from catching plenty of pips, is to pair up a strong currency with a weak one by first comparing their respective economies. How can we use their bonds yields to do that? Oh wait, so bullish. Important to know the underlying dynamic of why a bond's yield is rising or falling. Can be based on interest rates or can be based on interest rates, expectations, or based on market uncertainty and the flight to safety with capital flowing from risky assets like stocks to safe to less risky assets like bonds. After understanding how rising bond yields causes a nation's currency to appreciate, you're probably itching to find out how this can be applied to Forex trading. Patience, young Padawan. How rising bond yield causes a nation's currency to appreciate. Yeah, so it says pushing bond yields down. US dollar pushes their price higher, so bond yield should go down and then US dollar price should go up. But this one is bond yield going up and dollar also going up, so what? Okay, I guess hopefully explain more in the next lessons, but I am going to leave this episode here. So in the next video we're gonna be carrying on with how bond spreads between two countries affect their exchange rate. So thank you all for watching and I will see you in the next one. Later.